This is a quick video on an innovative idea for a long-term solution to household finance, and in particular, capturing those big college tuition dollars that we're sending off. At the core of it is opportunity cost. What is it? When we spend a dollar, we lose forever what that dollar would have otherwise earned for us. You either earn interest or you pay interest. Now, if you have a couple minutes, I want to show you a safe way to capture those tuition dollars so they're not lost forever, and they'll grow safely with guarantees the rest of your life. You can pay for tuition and have those dollars grow. There is a safe way to do that. Ordinarily, the college, sends you a tuition bill based on your expected family contribution, and you send them dollars right back. You could send that directly, and then it's gone forever. We're always climbing that hill of opportunity cost. Instead, what I suggest is let's capture that cash flow first with a properly structured dividend-paying whole life insurance policies designed by authorized practitioners of the infinite banking concept. The Nelson Nash Institute does a good job of training in the economic and insurance principles of the infinite banking concept. These are, high cash value, whole life insurance contracts issued by mutual insurance companies. And they're designed for high cash value instead of death benefit. And that's kind of the opposite of the way, Wall Street has you focus. This is a cash flow here that you were going to make anyway to the college. Instead, let's now make it a premium payment to the insurance company that creates immediate cash value for you, and it multiplies that whatever you were sending in into a permanent death benefit. And that multiplication, varies on a lot of factors, health and age and whatnot. And it immediately becomes collateral. That cash value in the policy is created right away, and it's collateral for a policy loan back to you, which you then send off to the college and pay your tuition, and everybody's happy. Everybody's right with the world. The kid's off at college learning, and your family capital is protected by this insurance policy. You have a death benefit providing great protection. It's permanent, and everything looks good. But wait a darn minute. Am I having to pay for college twice? Because before I was just sending the money off to college, and that was settled, but now I have a policy loan. I have a permanent insurance policy, which is great, but now I have a policy loan to pay back. Before, I just had to send the money to college, and I was done, right? Well, don't neglect opportunity cost. When we send money off to college, our family capital is shrinking. You have to repay and rebuild your family capital. So starting now and capturing capital with a policy lets you grow that capital and simultaneously, it advances you on that compound interest curve while you're using it, while, you've also sent the proceeds off to college. The insurance cash values are collateral. It continues to grow. You haven't liquidated it. If you wait until after college to start spending or to start recouping your capital, you're giving up those first few years of growth. And how big of a difference does it make to delay? Tens of thousands of dollars over here on the back end if you don't recoup those costs. And all along the way, your family's missing the protection of the large death benefit from your policies. Now, because you started later, you have to add much more capital to make up for the time you lost. This gap that needs to be filled. But what's highlighted here in the maroon section shows how quickly your available cash value is accumulated dollar for dollar as you pay back that policy loan from the insurance company. So you think of it as your own internal student loan. As you pay that back, it immediately becomes available for reuse. Your policy is that collateral, and it just keeps growing. So whatever you use instead of properly structured life insurance to store your wealth, stocks or whatever, in order to catch up to those cash values of the insurance policy, which are always growing, you have to pour a lot of cash in. Keep in mind as soon as you send in that policy loan payment, that cash value is immediately available for reuse, another loan for another purpose. That's up to you. There's no credit application or anything. You have complete control over that. And you don't have to wait all the way to the end to use it or until, the death benefit pays out. This is the most bare bone policy design I could make to get the point across. I wouldn't create this for anyone, but it's just an example. And it shows making 4 large premium payments, assuming 4 years at college. And most of that premium payment is captured as paid-up additions. And in order to send out a tuition payment right away, you need the cash value, and PUAs, as we call them, paid-up additions, is the quickest way to do that. So after those 4 years, you see no more premium payments are paid out of pocket. You can see there's no blue line there. Instead, these whatever premium is due is paid internally from the insurance policy itself. Now, I wouldn't do this in real life. We never want to be afraid to capitalize the policy, but I just wanted to isolate the cash flow to show how the repayments that you make on your internal student loan make the cash values available again for reuse. You have control. And these are, like I say, just annual increases. So even here in the later years, when you're not making any student loan repayments or internal student loan repayments or premium payments, the values continue to grow. Your cash value is always climbing toward that future death benefit. So, to summarize, instead of losing control of capital and losing that opportunity cost, losing that battle, here's just a better way to capture that college tuition or any major expense. Weddings, cars, big vacations. Start with your family capital. Instead of sending it off to college, run it through that policy first, hopefully a number of policies for all of your insured interests. Look for dividend paying, high cash value, whole life insurance issued from a mutual life insurance company. And these are non-direct recognition. That means that even if there's a policy loan, you still get the full dividend. And you get immediate cash value, big death benefit, permanent death benefit, and that's collateral for a policy loan, which you then use to satisfy the college bill. The whole program, it's economically sound, it's safe. We're always thinking long range. What does this look like in 20 years, 50 years? It's everything is protected from taxes. These are loans, so you're not paying income from these loans, income taxes on these loans. You're increasing your life insurance value as you use these policies. You get guaranteed growth. The costs are guaranteed. They're very predictable. But most importantly, you have control over everything. So I hope that was helpful, and give me a call.